Hey everyone, I'm your host Tom Shaughnessy, and welcome back to Chain Reaction, a research-driven podcast that's a part of Delphi Digital. If you're not on Delphi's research portal, you're missing out on the critical analysis read by the top minds in the crypto space, so be sure to check it out. One quick housekeeping item: nothing said on this podcast is a solicitation to buy or sell any security or token, or to make any financial decisions. I may personally hold tokens mentioned on the podcast, and you can view our show notes below for our complete disclosures. With that, let's jump into the episode.
Hey everyone, welcome back to the podcast. I'm your host today, Kevin Kelly, one of the co-founders here at Delphi Digital. And today we have another jam-packed episode of Macro Matters in store for you. I'm really excited to welcome Teddy Vallee to the show. Teddy is the founder and CIO of Pervalle Global, a global macro hedge fund. Teddy, thanks so much for you coming on today.
Yeah, thanks for having me.
We've got a ton to dig into. In the interest of time, I don't want to bore you and make you go through and give your whole spiel on your background. So we'll link to that in the show notes. But one place I did want to start was back in November. I've been a Real Vision subscriber for a while. And back in November, you had an interview with them that was titled Time to Get Bearish. And you were talking about these kind of massive divergences between global equity markets and PMIs and a variety of different indicators, looking at equity valuations that clearly were elevated despite lackluster growth or a lackluster growth outlook going forward. Obviously, you couldn't have foreseen what would happen or where we are today. But I'd like to fast forward to today and kind of get an idea from you where you think things stand and how your views, have changed since, we'll call it 6 months ago, and what you kind of see going forward here.
Definitely. So back in November, what we were looking at was a lot of our process focused on these long lead indicators and short lead indicators of economic growth. And our forward view from November, call it over the next 6 months, was that there's not really going to be a material pickup in economic growth. But the markets, primarily the equity markets, were pricing in a monster pickup in growth. A lot of the technology names, even some of the cyclicals, were looking for a rebound that we just didn't see. So at the time, we were pretty bearish on equities and said, look, if there's going to be a pickup, it's probably going to be in the rest of the world and not in the U.S. because of a lot of our leading indicators in the U.S. were still very, very bearish. Then, equities trade a little bit higher, and we started to see some of this emergence of the corona in China, which no one really was paying attention to at the time. They're locking down the city, and the equity market actually hit an all-time high following this. And it was pretty clear that this was going to have adverse implications on the global economic backdrop. So at that point, we were fortunate enough to take advantage of a very dire situation. And as it stands today, a lot of what we're seeing is still on the bear side with respect to the U.S. Outside of the U.S., we're pretty much on the same tune as it relates to growth. We think end of this year, you're going to start to see an inflection higher, primarily in China, and a lot of the Asian emerging markets that piggyback off of China. But the U.S. is going to have it's going to have a very long time of getting back to normal. And the reason that we say that and the work that we've done on that primarily relates to small businesses. So I think we were pretty early in identifying that the U.S. small businesses really didn't have enough cash flow to support themselves over a period of a month plus with no sales growth. Mm-hmm. So we've modeled out a lot of these numbers based on the cash flow of these businesses, and based on what we put together, we're estimating roughly 10 to 15% of U.S. small businesses are going to have to fold up shop, which is permanent damage done. That on the other side of this, they won't be able to rehire businesses. They won't be able to, rehire employees. The businesses won't be around. Mm-hmm. So that's a permanent economic damage that structurally sets it apart. And the same thing with Europe, just the way the economies and countries within Europe and also primarily the United States function. We're not able to just shut it down like China or lock lock it into make it just one specific to one city and shut down all transportation into that city. We're pretty free flowing here. Even though we were able to shut down, it still was not to the same extent as China or the rest of the a few of the Asian emerging markets. So if you look at the corona cases in the United States versus a lot of these Asian EMs, it's night and day. So the structural damage is really one of the things that we're worried about going forward. There's structural damage in the United States on the small business side and in Europe. So even though you can print as many dollars as you want for liquidity, it's not going to bring back, unfortunately, a lot of these small businesses to have to fold up shop. So right now, the equity markets we in the U.S. primarily are just not at all on the same page. They're functioning on a paradigm of the past, which is along the lines of when growth falls 1 sigma. Basically, the paradigm allowed the feedback loop that was created over the past 10 years was essentially low growth, reduced, brought down rates, which reduced volatility, which reduced economic volatility, which then forced people into riskier assets, which then reduced volatility even further, which created this very, very strong feedback loop. So right now, over the past 10 years, for example, equities have compounded at 14.2% per year on the back of this very, very strong feedback loop. And people have, come to this, created this stupid acronym called TINA. There's no alternative. Everyone has to go to the equity markets, and that's why they've had such strong performance. But the foundation of that paradigm and that operating thesis is only able to function if growth is growth falls only 1 sigma from the mean. On a multiple standard deviation move, you can't get back to, you can't repair growth to a level that gets it back to the prior high, which is what's happened since 2009 every time. We've had 4 separate growth slowdowns, but it's never been enough to puncture the severity of the economic backdrop to start laying off employees. Now we have that, but the equity markets are still operating under the old assumption of, look, everything's going to pick back up. We're going to be good, primarily because of this central bank, we'll call it the central bank sort of chatter and crutch that historically has allowed equity participants and people to take risk waiting for that growth to pick up. But like we just mentioned, it's permanent impairment of growth. So that's not going to come back. So now the equities are sort of going to be in this Wile E. Coyote moment of there's not going to be this V-shape, U-shape potentially, but we're really worried about that permanent impairment of a lot of these small businesses.
Right.
The issue today is everyone's already sold that needed to sell. So positioning is very offsides. Not that many people are overweight equities or even, exposed to the equity market. So in terms of it moving lower, there's not a lot of support for sudden moves. So that's sort of where we're at today. With the macro backdrop, we can get into some specific assets if you want, or we can go over what other questions you have.
No, I think that's actually a great place to start in terms of, the gap we continue to hear about widening between, call it Wall Street and Main Street. And I think small businesses, to your point, certainly sit at the center of that argument. And, my question to you would be, when you talk about stocks as potentially being, even a leading indicator of things to come. And obviously, when you look at something like the S&P 500, you have to understand the composition of it, the weighting of it. The top 5 names, 20+% at this point, make up of that index. The rally back that we've seen from those March 23rd lows, north of 30% right off those lows, do you see that as more of kind of we'll call it a technical retracement, or the market trying to discount, I guess, a better outlook for some of these larger tech companies in the aftermath of this, as you see kind of industry consolidation, potentially accelerate things of that nature? Or is it just that the equity market by and large, is simply just, for lack of a better word, incorrect right now?
So I've been operating under a completely different thesis over the past, call it 1.5, 2 years, that has really helped me stay alive and actually profit from what's going on in the markets. And the primary view is that equities no longer discount the future. For some reason, over the past 2 years, there's been such a large discrepancy between the very obvious forward events in the equity market. For example, in October of 2018, it was so clear that there was a global economic slowdown, and our leading indicators were completely showing that. But equities, were hitting an all-time high, and then subsequently fell, 20% in almost straight line. The same thing just happened again. Now, maybe they overshot to the downside in December of 2018, but then they rallied back to an all-time high. And then after we saw the outbreak of Corona, they did the exact same thing. They hit an all-time high, and it was very clear that the economic damage from this globally was going to be pretty severe. So I've been operating under this assumption that the equity markets really don't discount forward growth to the same. Maybe the internals do, so specific asset classes, relative ratios, but the headline equity indices are not the same type of discounting mechanism that they have been in the past, for whatever reason that is.
And you saw that too, heading into as COVID started to really pick up, right? I mean, even the market topping or peaking in, late February, mid to late February, February 19th, you could make the argument that the writing was certainly on the wall there as well. That there should at least be some type of effect on equities, and they shouldn't be breaking all-time highs too, right? Because the timing
has to be some type of handicap.
Yeah,
right? Like there has to be there has to be a little bit of discount for the potential risk of the now very obvious in hindsight, one of the largest economic collapses in history. And that just wasn't the case. So, operating under this assumption, it's been a lot easier to be, size positions and think about the markets in that way, and really focus on the technical work to then take advantage of when things break. So to your original question of, is this a technical retracement? I think the move down was probably too significant for, because again, back to how markets function over the past few years, they go so far in one direction. These vol selling strategies, everyone basically just gets in the same side of the boat, and it's a direct line. Like 2017, the volatility after it was just so low that it's nothing we've ever seen before. So everyone plows in one direction, and then within a week or 2 weeks, we reprice to actually what they should have been discounting, 6 months, 6 weeks, 6 months prior to that. So the moves, when they do go, are so fast, so vicious, because everyone is on the same side of the boat. And it's not just over positioning. It's sort of the next level. So then you get these vol events where things just unwind within 2 weeks. And that's sort of what we saw. And unfortunately, that was the amount of leverage and the amount of things that basically built up over the past 10 years was unwound within multiple weeks. And we probably overshot to the downside given the information. And now we're definitely overshooting to the upside. And the thing is, I'm mentioning that they're not able, I don't think they're able at a headline basis to discount very well the future. The future right now is unbelievably uncertain. And when it's so uncertain, this has never happened before. The market participants aren't able to handicap or discount what the future looks like. And they've been guided by the Federal Reserve by doing basically, unlimited, and by, constant, payroll tax cuts and potential announcements, these payments to unemployment payments, one-time payments. So everyone's hearing, all the stimulus, and now there's $3 trillion that potentially that the House proposed. That is clouding or making it difficult, and no one does analysis anymore. So, no one's actually thought through what the economic damage of this is. Just like, oh my God, 10% of GDP, the Fed's unlimited, you got to buy it. And so the initial reaction is that. So for right here, I think we chop around for a while until positioning gets a little more one-sided, because everyone that's sold is already sold. So it's tough for us to sharply go down. So therefore, the next move would likely be a grind lower.
Right.
I would be into the end of the year when things really start to improve outside of the United States, but could potentially improve in the U.S.
And when you're to that point, when you're talking about different indicators and the analysis you guys are running, right? And obviously without giving away the secret sauce, what are a few examples of things you're looking at that either other people aren't, or you're just kind of blending together as a stable tracking mechanism to figure out when you think, this we'll see a bit of a turnaround here, a reversal in the growth trend? Because to your point, I mean, even the data pricing is obviously very volatile, but even the data right now is incredibly volatile. So how do you kind of, weather through that?
So two parts. The first part is a lot of the stuff we've built is all proprietary in terms of the leading indicators. So we've, over the past several years, built out this process in which we have an idea of what growth in the future is going to look like based on our long leads, but also we've created this thing called the Real-Time Pmi, which effectively measures the internals of global markets and has roughly 90% correlation with the global PMI. So historically, when you have these large shocks, the leading indicators don't work because there's different variables and it's not a natural sort of process between called lower rates and credit growth. And because of that, we've really had to rely on this real-time PMI indicator and really look at the market internals to understand what they're saying to us. Recently, they've improved a little bit, but from very, 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 poor levels. So those would be two examples of some of the things we're using. We'll also have a bunch of liquidity indicators to give us an idea of, just because something's overvalued, it can become more overvalued if there's a very positive liquidity backdrop. And I guess it goes vice versa. So the liquidity backdrop right now is still pretty negative, but towards the end of the year, it really begins to improve, which makes me a little more optimistic on the rest of the world scenario, especially as some of the Chinese data comes in and it's looking a little bit better than a lot of people would have expected given the circumstances. So a lot of stuff that we look at is built in-house and proprietary to what we do, but it's all available data. It's not, we're just looking, I think, at the data in a creative way versus, I guess versus everybody else. And I think one of the things that we've been able to do that really no one else has is we've had to get creative in terms of the analysis of what's going on here because the long leading indicators are bust because of the economic shock. We've really started to dig into alternative data and then apply that alternative data to studies that JP Morgan, for example, did on small businesses, which showed cash flows in and out of 600,000 of their customers on their Chase banking platform. So we've effectively used alternative data that's available, that's public, and then taken a model that is very statistically significant and been able to derive roughly the numbers of permanently impaired businesses. So it's essentially taking what's out there and getting creative with it to have an edge in analysis. And I think a lot of people don't even get as far as to look at just beyond the stock price. So,
right. No, it's definitely a refreshing thing to hear for sure. Because as I mentioned, I followed your work and a lot of what you guys do. I'll link again to the show notes of your Twitter profile too, because it's just a great follow. Guys like you, Tavi Costa. I mean, I live and die by that stuff just because, again, a good shark can say 1,000 words for sure. But to your point about going outside, kind of venturing outside the U.S., one of the things that, I sit here in the U.S., was a U.S. equity strategist before this, but oftentimes in some of our analysis too, you would obviously want to have the global macro picture. And I think a lot of people obviously have that kind of home country bias, right? So a lot of people tend to invest in, U.S. assets. The reason I wanted to come back to not only, your ex-US kind of growth or longer term outlook for some of those asset classes, what I also want to hit on is the dollar and get your take on what you guys see for the dollar going forward. There's obviously a lot of debate right now, whether you get this kind of final dance, this last dance for the dollar higher with the global dollar shortage, global growth contracting, this kind of flight to safety potentially, and U.S. assets like treasuries. And then obviously that could be the final kind of, I guess you'd say, straw that breaks the dollar's back. How do you guys, and I know I'm kind of throwing a lot at you, but how do you guys kind of think of the dollar in the center of some of these larger kind of macro trades, like, what's going on outside the U.S. and the growth profile of some of those countries or equity markets or whatever?
Sure. So the dollar right now, in my opinion, is sort of a no touch. I don't think you have an edge one way or another today. Now, as we get towards the end of the year, I think you're going to have potentially a multi-year or roughly a short-term top in the dollar on a trade weighted basis. I don't love the Dixie just because of its composition, but on a trade weighted dollar, I think with the rest of the world improving from a growth perspective and the U.S. really being hampered down, I think that sets up for what a lot of people have been calling for a while, top in the dollar. Now, from here to December, like I said, I think it's a no touch. I think it could trade higher if growth really continues to slow. As if things really do not pick back up, then the dollar's going to absolutely rip. Mm-hmm. But under the assumption that we get to the end of the year, things don't look great, but the rest of the world's starting to pick up, I think that you could have a potential multi-year top in the dollar, primarily based on that, but also some longer-term structural things that I can get into as well. And one of them being, we just put together our Q2 note on what we're seeing going forward, and the title of the CIO thoughts section is called the macro decade. So effectively, what's happened over the past 10 years is that feedback loop that I mentioned previously, where lower growth, lower rates, lower vol, has increased people's risk tolerance and put people in primarily into equities, which led them to compound at 14.2% per year, which is the 97th percentile historically. So we have 4 or 5 separate forward return models that are based positioning. So, for example, the Wilshire 500 relative to total household assets is about 40%. So historically, when you get up to these big numbers, the forward returns of U.S. equities are really dismal. So we have 3 valuation, 2 sort of positioning, and all of them are saying the forward returns for U.S. equities are basically 0 to negative per year for the next 10 years. So, from a long-term basis, the merge with the corona and some of this potential permanent damage actually reinforces the view that we had prior to this, that U.S. equity returns were going to be really, really poor going forward. Now, like you were mentioning, the rest of the world, primarily emerging markets, actually has a positive return per year. So that divergence just from an equity profile, positioning profile, return profile over a longer term really sets up for U.S. underperformance after the end of this year. Now, I don't know specifically the timing, but if it's going to happen, it will likely be from the fourth quarter. Beginning of it will be into the fourth quarter, beginning of the first quarter next year. But again, things change, and that's sort of where we're operating currently.
And so that's a great point, because we've talked a little bit, gone back and forth about you guys, and one of the reasons we got connected too is you're starting to tweet a bit about Bitcoin. And as you've probably noticed in this space, the moment you come from kind of a global macro perspective, and then you tweet about Bitcoin, next thing you know, you've got a bunch of people probably commenting, liking, retweeting, DMing you, all of that. You kind of join the tribe. And the same thing kind of happened here. I saw you starting to tweet about it. And so I was like, hey, would be great to connect. Would love to hear your thoughts, because I'm always curious to hear from a global macro perspective what turned you guys onto this. And I think, in a note you and I were going back and forth about before this, if you could kind of lay out how you guys got to looking at Bitcoin from a, almost pure like investable asset class or asset perspective. Because I think the framework in which you have in terms of what you just talked about, the 10-year expected returns, real returns for global equities, especially U.S. equities being negligible or negative, similar with probably fixed income and both corporates and sovereigns, just because of where starting yields are today. Kind of walk through how you guys got to Bitcoin, what turned you on about it, how you see it kind of from that multi-asset perspective. I think that would be really helpful.
Definitely. So I'll pick up where I just left off in terms of these return profiles. And this was sort of when we founded the firm, the idea was that macro's back and that active trading is going to be back, and that this passive, I'll just leave it at this passive era.
Yeah. I love that too, because it's right on your website, right? Just macro's back right there in bold.
Macro's back. I think we're entering into a purely, maybe it's active macro, but I think it's becoming a very, very macro environment, primarily because U.S. equities you're not going to be able to hold. So let's go to the next iteration. So after we basically did this analysis of all the global equities, and the one place that you have returns was emerging markets. However, if you looked at all equities on an aggregate basis, based on our models that I was just talking about, and specifically on the valuation side, the aggregate real return of global equities over the next 10 years is zero. It's actually negative. So you say, okay, if that just takes out $73 trillion of assets that have no return, where can I go to make money? Well, I could go to the bond market, but then we broke down both the global corporate and sovereign bond markets and looked at the effective real yields that you get from holding the market as a whole over 10 years. On a real basis, that's also negative.
And that's the global, we'll call it
everything.
Aggregate. Right.
It's corporate, sovereigns, everything. Some securitized products. That is also negative on a real basis. So now you have a situation where 130 trillion of, roughly 100 and no more than that, $183 trillion. This discounted a little bit after the equity sell-off.
Right.
Has no return. This is negative return from investing it on a passive basis over the next 10 years. So after we put that together, like, all right, wow, that's
not a good start.
That's significant. So how do you make money during that period? Well, one, you're an active guy and you focus on growth cycles. So, there's going to be multiple growth cycles like we've seen, 4 separate ones today. But, from the high in 2001, for example, to you didn't break that high till 2013. So it took, multiple years to break that. However, there was multiple growth cycles. So our excitement for these next 10 years is, okay, if point A to point B is 0 in terms of return profiles, there's going to be multiple cycles along the way. And based on our process and having a macro sort of backdrop and forecasting growth cycles, we should ideally be able to take advantage of those throughout that period of time versus, buying and holding. So the whole passive industry is going to have a very, very difficult time. Now, for those guys that are invested in that, I assume they're going to get pretty frustrated over a period of time with $183 trillion, and they're going to try to figure out where to put that. There's only so many hedge funds, so maybe they do it themselves, and that leaves the commodities markets or this little new thing called Bitcoin. So, I think from a structural standpoint, you have a significant amount of assets that needs to find some type of return. Now, I think gold has a very, very positive tailwind, but I was talking with my analyst today, and there's a scenario which we don't know if it's going to manifest or not, where there's a significant amount of deflation, which is very, very bad for gold. So if that situation does manifest, then you have all this capital, 190 trillion plus, that needs to find a home and needs to have some either likely store of value because everything is losing money. So the macro backdrop of that is just unbelievable for Bitcoin. So then we started, thinking about, all right, if that is the potential tailwind, what else do we have going on? Well, central banks are just going. It really clicked for me, or where I really got excited about it, was over the past 3 months when the monetary policy from the Federal Reserve, I thought, would play out over multiple years, probably 2 years before they, and from on the fiscal side, before they started handing out money, before they started buying, corporate bond ETFs, before just ETFs in general, talking about yield curve control, all this I thought was going to play out over multiple years. So I said, okay, under that presumption, Bitcoin over the long term looks very attractive based on the craziness of what's going to happen. That all got pulled forward within a month, where it just was all rolled out. So that sort of really started to get me moving my feet. I've been trading it for 6 to 9 months now, but really starting to do the work and think about it as a tradable asset class, and from a flows perspective, from a top-down perspective, the tailwinds that you have there, and also the user base, primarily being millennial, and inheriting a significant amount of money, and primarily being focused on that, on technology and technological space. You just have such an unbelievable this is just the store of value piece, right?
Mm-hmm.
I mean, the applicability and, the use cases of it on the separate side, we're still, I mean, it's, as you know, it's very, very large. So we're still modeling out potentially what, all that looks like. And I think that's going to take time, but we know, by dipping our toes into it, that it's very, very large. And from a return perspective, I mean, my job and our job as a firm is to produce the best possible returns possible, right? With ideally the least amount of volatility. And, as you look out over the next 10 years, I just said, it's going to be very difficult to make money on a passive basis in both stocks and bonds. On an active trading basis, it should be interesting. But from a secular return perspective, the amount of upside in Bitcoin seems pretty crazy.
Yeah.
Maybe I'm wrong, but you have everything, you have all the pieces in place for a monster secular tailwind, similar to the internet and these technology companies.
And at that point too, it can even become as simple as a probability game too, right? Which you're thinking about, again, you could be wrong, but when you're looking at that, we'll call it global market outlook that you just laid out, I mean, it's not like you'd expect, you're going through some period where you expect, again, growth trends or secular growth to increase, in which case, maybe you do have huge opportunity cost risk of not being in U.S. equities, for example, right? Like the last decade. I think that's a really good point, and it's one that I think we're starting to see more people, more smart money and sophisticated investors wake up to. The point about pulling forward, let's call it the next 10 years of macro, right? Or pulling forward the amount of monetary and really even fiscal stimulus that we've seen just in the last 2 to 3 months. Do you think that's also pulled forward, I guess you could say, the timeline for Bitcoin to prove itself, right? It's one of the things we've been thinking, and I'd love to get your thoughts on, because again, we can talk about 5, 10, 20 years, 30 years from now where we think Bitcoin can be and sitting in this new kind of digital world that we're moving or accelerating towards. But do you think from an investor standpoint, the fact that you have this backdrop and it's come so quickly, that's kind of pulled forward the way in which you guys are monitoring Bitcoin, or the, I guess, expectations for Bitcoin to do what we all think it can do?
I think yes, for sure. In the sense that the guys in the macro space are starting to warm up to it and think about it, especially after what the Fed's done. The Paul Jones news, and a lot of other high profile guys that are off the radar are also starting to really take interest in it. I think it has pulled it forward, but in terms of proving itself, I think that's going to take time. For example, and I think that it's also, everyone's still trying to figure out what it is, what effectively it is.
Yeah.
After it's sold off, all these Bitcoin haters were like, "Oh, it's supposed to be a store of value. It's supposed to be a hedge, against calamity." And there it is, down 50 points. And I don't think it's such a new asset that it's still developing its role. And we've actually done some interesting work on it, that it actually does correspond to, and I get a lot of pushback to this, to macroeconomic growth cycles. The highest returns of Bitcoin come in global growth up cycles, which likely has something to do with liquidity and also increasing user base and more people have more money.
Mm-hmm.
But the biggest years of Bitcoin's gains have come from growth up cycles. So that would sort of augur that it's actually an economic asset and not necessarily the digital gold that it potentially could be. But then at times, when there's China risk, it trades up 15, 20% like we've seen in the past. So I think it's still establishing, and maybe it will never have like a definitive, this is what it is, because it's so many different things. But back to your original question, I think that in terms of the understanding within macro community and investors, people are starting to take note of it. And that has definitely gotten pulled forward, as has our sort of view and evolution within the space, because of a lot of the monetary policy of the Federal Reserve and global central banks.
Yeah. And it's funny you bring that up in terms of just the growth cycle and seeing how Bitcoin reacts and how it tends to trend during those growth cycles. Because we've looked at some similar data. And I think part of it, too, to your earlier point about what the last 10 years has looked like, that lower growth environment, right, that's we all know has pushed people further out the risk curve. And with, starting bond yields where they are today, I think some people will start to look at it too, almost as, call it a quasi growth asset. Obviously not a perfect, corollary. But I think that was one of the ways in which people looked at it too, because again, you can get into how it's an uncorrelated asset over longer periods of time. But when you look at, just the way in which, equities have performed and specifically within that growth equities, it does have a pretty, decent correlation with those cycles. So I think it's a really good point to bring up.
Yeah, and with the S&P, the biggest returns come with when the S&P, which typically also corresponds with growth, come with the S&P being up big. And over time, maybe that shifts a little bit, and it trades maybe more off of at times it trades off of real interest rates. It's so creative and clever, and it's exciting to just essentially watch it evolve. It's like a new kid.
No, absolutely. And how do you guys, so to that point, when you're thinking about correlations, right? Because it's one thing to look at how correlations have trended over time, but when you're talking about forecasting returns for different asset classes, looking at these different growth cycles, do you have expectations for how Bitcoin trades going forward relative to other asset classes? Do you think, we've started to see it break a bit away from equities again, after you see these big volatility spikes that typically tend to result or coincide with big sell-offs in Bitcoin. Going forward, do you see it trending more towards, again, that safe haven kind of high beta digital gold narrative and trading more in line with something like gold? Or do you see it, still trading more in line with some of the riskier assets?
That's a good question. I would say, to be honest, we haven't fully figured it out yet. I think the times to really hit it are going to be when our liquidity indicators are positive, and hit it meaning, put a good amount of capital behind it. Mm-hmm. When liquidity is very positive and we do have that growth upcycle. And, I think, but at the same time, the way we're approaching it is we're not going to try to trade it as much versus just holding it in the portfolio. Yeah. I started off as a long-term investor, but I really haven't found or put capital behind my personality is much more suited to trading than long-term investing. But this, to me, is the first thing in a while that on a long-term basis is pretty attractive. So I think we'll watch it and how it evolves. And as we learn more, like I was mentioning before, we're just dipping our toes into the space in terms of the analysis. And I think over reading y'all's work and then doing more ourselves over the next 3, 6, 12 months, I'll have a better answer for you.
Yeah. And how are you guys managing or because I don't want to say thinking about the Bitcoin position, how are you managing that position you guys have relative to other, obviously assets within your portfolio? And I guess what are some of if there are any kind of struggles or nuances or things you kind of had to get up to speed on in terms of, custody and things of that nature? Just how are you guys managing the risk of that position? Maybe even outside of just the fact that it's obviously very volatile, right? You guys you're used to being global macro, you're used to, a volatile asset or a volatile asset class, but from a pure kind of managing the position perspective, are there any things, is there anything that's kind of notable or surprised you by, kind of getting into this space?
Well, one of the things I would say is the way we manage risk overall is beginning of the year, we tend to start off smaller. So effectively how we've sized Bitcoin is like, okay, historical drawdowns, typically the highest probability of a drawdown is like 40 to 43%. Now we're basically just going to chalk it at 50 to say, okay, given this positioning, let's just assume this goes to zero or so down 50, sorry, not to zero. No one wants that.
Non-zero chance. You always got to address
exactly, it. Exactly. This goes down, 50%. What's our risk on this? And then as we grow our equity base throughout the year, we're able to take more risk. So ideally, I'd like to have the position going forward around 3 to 5% and let it grow, and then constantly trim it. And we're working on some of the math now as to what that would add, given our price target in the future, which we're still working on, what that would effectively add to a portfolio. There's been a lot of analysis of the past. It's like over the past 10 years, if you've had, 1 point in it, it's added X, Y, and Z.
Mm-hmm.
So from a risk management perspective, we're effectively saying, okay, 40 to 50% drawdown, just going to happen. Therefore, how do you size it? How do you keep it within the risk protocol of the book? And then you just let it run. We really started, I had a small position on prior to the sell-off, and then really added to it, fortunately. So far it's been good to us. And, the more, I think a lot of people in the space, the more work they do, the more they like it. So,
yeah,
I think it could really add. It's difficult in the sense that it's a very volatile asset. It's very new. So putting a large percentage of your book in it is difficult, but I hope eventually one day that we'll be able to get there, and it would, add return to the book, because I think, in this period of active management that I think we're coming into in macro, I think this is going to be one of the asset classes that macro guys need to pay attention to and can really help your performance overall.
Yeah, no, 100%. Couldn't agree more, obviously. And so one final point or question I want to ask you, and it's not to put you on the spot at all, because it's just something that we try and think about as well. But from the flip side, obviously a very kind of bullish outlook, as do we, on Bitcoin longer term, and even really in the shorter to medium term. What is one or a handful of things that could, I guess, derail your bullish thesis on Bitcoin? Is there anything that you could have or you could see come out now? Anything in the macro space, anything at all that could deter you away from, I guess, the work you guys have done in the bullish case you've made so far for it?
Yeah, I think if you see anything like we saw previously, which could happen again, in the sense that massive, large-scale deleveraging across every asset, even including gold, getting sold down 4 points on the day just to meet margin calls. I think that scenario for a new developing asset, and even with established assets like gold, they still got smoked, along with even treasury. So financial instability,
Mm-hmm.
I'd be worried about. But then the sizing thing makes it so that like those situations are okay. I think if people start to lose faith in it as something of a store of value, which I think is a low probability, given the people that seem to really understand it are my generation, millennial, your generation, people that grew up with technology.
Mm-hmm.
If for some reason there is a spark that leads this cohort from believing a hack, or believing that it's actually a store of value and they need to put capital somewhere else, then I think that's going to be difficult for the space. Also potential regulatory things that hamper it, but nothing that I'm not seeing or think. These are all answers that you've likely heard before, and that are on the radar.
Yeah.
But in terms of what would keep me up all night with a big position is some type of large scale deleveraging where everything's sold. Or some issue with the technology that's not been seen so far, or So I think overall,
and even regulatory risk, I think, is actually a really good one to bring up too, right? Because a lot of people say, you can't shut Bitcoin down necessarily, and while there's obviously a lot of merit to that argument, if you had, let's say even G7 countries come out and just all at once have a broad kind of ban on holding, trading, being involved with Bitcoin or crypto assets in general. Maybe you're not shutting down those networks, but I think you're certainly suppressing it into kind of the black market days or stages, in which case obviously that would have a pretty substantial impact on price.
Yeah, exactly. And then your use cases goes down, and then overall the potential valuation of the asset itself.
Yeah. No, absolutely. Teddy, listen, I really, really appreciate you coming on. I'm excited as you guys dig into this space more to bring you back, hopefully in the next 3 to 6 months, see how your thesis is evolving, seeing any work you guys are doing on this. But again, really just thank you for coming on and sharing your insight.
Awesome. Thanks, Kevin. Appreciate it.
Hey, everyone. Thanks for listening to the podcast. If you enjoyed it, please support the show by hitting subscribe on iTunes, writing a review, or sharing this episode on Twitter and LinkedIn. And stay tuned for our next episode out soon.